Welcome in, everyone. We're really glad you're here joining us today for this deep dive because we are looking at a day that, well, it basically fractured the global economy.
Oh, absolutely. Fractured is the right word.
Yeah, Thursday, June 18th, 2026. A single 24-hour window where, everything just shifted at once.
Right. The tectonic plates moved.
Exactly. I mean, the United States signs this sweeping peace treaty with Iran. Then the Federal Reserve just throws out a decade of established monetary policy.
Just completely tosses it out the window.
Yeah. And on top of that, the U.S. government effectively nationalizes this huge chunk of Apple's physical supply chain. So our mission for you today is to unpack this exact moment.
And we brought a lot of material to go through.
Oh, a massive stack of sources. We've got macroeconomic reports from Saxo Bank, the NAHB and Wells Fargo Housing Market Index.
Plus the global trading calendars.
Right, those calendars. And this really comprehensive, just incredibly detailed analysis piece that is literally titled The Great Convergence.
Which is, honestly, the perfect title. I
Okay.
mean, we aren't just looking at isolated market movements here.
No, not at all.
We're looking at geopolitics, aggressive monetary policy, and this completely new form of state-sponsored industrial strategy. And they all just collided on a single Thursday.
To rewrite the rules of global finance. Okay, let's unpack this. Because to understand the economic whiplash of this specific day, we really have to look at the massive geopolitical domino that fell first.
The Geneva Accord.
Yes, formerly referred to in our sources as the Islamabad Memorandum.
And you have to understand, this document is the absolute foundation for everything else that rippled through the markets that day.
Right, so the U.S. and Iran have officially signed this 14-point interim peace agreement. And the stated goal is to, end the regional hostilities.
Which is obviously huge.
Yeah, but crucially for the global economy, the goal is to reopen the Strait of Hormuz. For you listening, if you're looking at the structural flow of global energy, the Strait of Hormuz is basically the global economy's physical choke valve. I mean, it carries roughly 1/5 of the entire world's petroleum.
Exactly, 1/5. It's the jugular vein.
So when that valve is restricted by conflict, the whole global supply chain gets, acute hypoxia.
And that restriction was the defining feature of the market for the entire first half of the year. The blockades, the intense conflict, it paralyzed Iranian exports.
Yeah, completely paralyzed.
But more broadly, it slapped this massive war risk premium on basically every single barrel of oil shipped anywhere.
Because the physical transit routes were compromised. So let's look at the actual text of this 14-point framework from the sources. It's highly specific.
Extremely.
Point 1 mandates the immediate permanent termination of military operations across all fronts.
Right.
It specifically dictates stopping the conflict in Lebanon and preserving Lebanese sovereignty. It's just a hard, immediate stop to the kinetic warfare.
But the financial markets, the algorithms, they immediately zeroed in on the maritime clauses.
Oh, for sure. Point 4 outlines that the U.S. will completely end its naval blockade of Iranian ports within 30 days.
Trying to get back to pre-war vessel traffic.
Yeah. And then point 5 establishes this 60-day trial period where Iran actually guarantees the safe passage of commercial vessels through the Persian Gulf.
Which leads right into the financial mechanics, the teeth of the deal.
Yes, points 10 and 11.
Right, so these dictate the U.S. Treasury issuing formal waivers for crude oil and banking transactions.
Along with unfreezing Iranian assets.
Exactly, releasing those frozen assets to be used for monitored payments.
And the market reaction, instantaneous. I mean, Brent crude dropped 3% on the spot market, hitting 77.20 a barrel.
A massive drop.
And WTI, the U.S. West Texas Intermediate, that dropped 3.4% to 73.46.
The conflict premium basically just evaporated in minutes.
I did. But here is my pushback on this whole narrative of Sutter abundant energy.
Okay, let's hear it.
I'm looking at the physical inventory numbers from the Middle East Daily and MUFG research. The U.S. Strategic Petroleum Reserve just hit a 43-year low.
Right. 43 years.
So if peace is declared and oil prices are dropping on the screens, why did the SPR hit that low? Shouldn't we be, swimming in oil right now?
Well, what's fascinating here is that the physical reality on the ground is drastically different from the sentiment on the trading floor.
How so?
There's a massive lag between politicians signing a paper in Geneva and the brutal logistical reality of global shipping. I mean, a signature doesn't magically sweep the Persian Gulf for acoustic mines.
Right, the mines deployed during the fighting.
Exactly. The maritime analysts in our sources heavily cautioned that returning to normal volume requires physical, third-party verification of those routes.
Because no commercial ship owner is sending a $100 million crude carrier through the strait just because of a press release.
Oh, way. And their insurance syndicates absolutely won't allow it. The underwriters at Lloyd's of London, they really dictate global shipping through their premiums.
And those premiums are still high.
Astronomically high. War risk premiums haven't dropped yet, so that geopolitical discount in oil prices, it's going to experience a serious lag before it shows up in physical delivery.
Oh, I see. So the spot price drops because traders are pricing in future probability, but physical barrels moving today are still dealing with the costs of a war zone.
Yeah, total war zone hangover. Plus, you have to factor in the structural decay in infrastructure. Look at Cushing, Oklahoma.
Cushing is the primary physical delivery hub for WTI crude, right?
Exactly. And our sources show physical inventories there fell for the 8th consecutive week. They're nearing 20 million barrels.
Which is low.
It's the lowest since 2014. But more importantly, the macroeconomic reports highlight that 20 million is dangerously close to tank bottom operational minimums.
Wait, tank bottom? Meaning they can't actually drain the tanks to zero?
Right. Oil storage tanks accumulate water and heavy sludge at the bottom. If the volume drops below that 20 million threshold, the pipelines suck up sludge.
Oh, wow. That would ruin the refineries.
It causes catastrophic downstream damage. The whole system seizes up. So you have a dissipating war premium pushing paper prices down, but critical physical inventory is putting a hard floor under those prices.
Man, that is a really fragile balance.
Highly volatile.
And normally, when you see a massive geopolitical de-escalation that lowers future energy costs, you'd assume inflation will cool.
Cheaper energy means cheaper freight, cheaper manufacturing.
Ultimately, cheaper consumer goods, yeah. And if inflation is cooling, you'd expect the Federal Reserve to relax a bit, take their foot off the brake.
That's the traditional macroeconomic playbook for sure.
But the Fed did the exact opposite, which brings us to the second major convergence, the monetary paradox.
This was wild.
Yeah, here's where it gets really interesting. The markets were absolutely blindsided by what the sources are calling the Warsh pivot.
Kevin Warsh's first FOMC meeting as the new Fed chair. He completely rewrote the rulebook.
He did. The rate decision itself wasn't the shock, right? They held the federal funds rate at 3.50 to 3.75%.
Yeah, the market had priced in a hold.
But the message attached to it triggered a massive reassessment. The Fed officially dropped its easing bias.
That's huge.
9 out of 19 Fed officials now project at least one rate hike by the end of 2026. Back in March, nobody projected a hike.
Complete reversal.
And their inflation projections drastically raised. The 2026 PCZ, the Personal Consumption Expenditures Index, the Fed's favorite gauge, is now forecasted at 3.6%.
Up from 2.7%.
Exactly. And core PCZ is revised up to 3.3%.
So the committee is essentially admitting that systemic inflation is way more sticky and entrenched than any of their dovish models suggested.
Right.
Regardless of falling oil prices.
Right. And Warsh didn't just tweak the dots on a plot. He announced a sweeping institutional overhaul, 5 brand new task forces.
A total systematic dismantling of the status quo.
Let me list these because it's intense. A review of their communications framework, a deep dive into balance sheet size, a review of data sources.
The AI impact study, too.
Yeah, a dedicated study on AI's impact on worker productivity, and a total reevaluation of their inflation targeting framework.
Changing how central banking has operated for 15 years.
It's like, okay, imagine you've been driving a car for a decade, relying entirely on your GPS to tell you every turn 3 miles in advance.
Okay.
That GPS is the Fed's old forward guidance. They always telegraphed what they'd do months in advance to soothe the markets.
Right. Highly predictable.
But Warsh just reached over, ripped the GPS out of the dashboard, and said, from now on, we are navigating purely by looking out the windshield.
That is exactly what he did.
It's highly reactive, deeply data-dependent, and the market realized they lost their roadmap.
And the bond market's reaction was incredibly violent. We saw a dramatic bear flattening of the yield curve in a single session.
Let's break down that bear flattening because the specific basis point movements here are critical.
Yeah, the numbers tell the story.
Following the announcement, the 2-year Treasury yield, the short end, which tracks Fed policy, spiked aggressively. It jumped 15 basis points to 4.22%.
Right.
Meanwhile, the 10-year Treasury basically didn't flinch. It stayed anchored right near 4.44%.
And the resulting gap, the 210 slope, collapsed to just 28 basis points,
So short-term borrowing costs shot up to almost meet long-term costs.
which fundamentally alters the flow of capital.
Yeah.
Look, a normal yield curve slopes upward. Locking money away for 10 years has more inflation risk than 2 years, so you demand a higher premium.
Makes sense.
When the short end spikes up to meet the long end, flattening the curve, it signals a massive paradigm shift in how the market perceives risk.
And it's a bear flattening specifically because short-term rates rising drove it, which destroys the value of existing short-term bonds, right?
Exactly. It wasn't long-term rates falling. It's short-term pain rising.
So the bond market is basically broadcasting its real-time assessment of Kevin Warsh's credibility.
If we connect this to the bigger picture, the market is pricing in that Warsh is entirely willing to inflict acute short-term pain on the economy through higher borrowing costs.
But because the 10-year stayed at 4.44%, the market fundamentally believes his strategy will work to crush long-term inflation.
Yes, the bond market is saying, we believe you'll choke growth today, but we trust you'll secure price stability a decade from now.
They trust the medicine, even if the side effects are brutal.
And we saw those side effects ripple instantly into precious metals. Just look at the price action on gold during this session.
Well, traditionally, with a massive Middle East peace deal, the safe haven premium evaporates and gold drops.
Right, which it did.
Gold dropped heavily to $4,250 an ounce. But the sources indicate it wasn't just the Geneva Accord pushing it down, it was the massive pull of the Fed.
Because gold is a non-yielding asset, it doesn't pay a dividend or a coupon rate.
Yeah, it just sits there.
Exactly.
Yeah.
So in short-term, risk-free Treasury yields spiked to 4.22%, the opportunity cost of holding a static asset like gold becomes mathematically prohibitive for large portfolios.
Asset managers just dump it.
They dump non-yielding safe havens to chase those high guaranteed government yields. It was a perfect storm for gold to sell off.
Okay, so we have a geopolitical shock lowering future energy costs, colliding with a monetary shock drastically raising short-term borrowing costs.
A brutal combo for equities, usually.
Right. Historically, when a new Fed chair comes out swinging like this, dropping the easing bias, the stock market completely panics.
High interest rates are toxic for equities, especially capital-intensive growth stocks and tech. It makes their future cash flows inherently less valuable.
But the tech sector completely ignored the Federal Reserve today. They shrugged off that 4.22% yield like it didn't exist.
Completely immune.
And the structural reason for that brings us to the third major convergence. Because while the Fed controls the cost of money, the White House just fundamentally changed the absolute source of the tech sector's money.
Yes, the Silicon Shield.
We have to talk about this historic state-sponsored reshoring of American technology.
This is where domestic industrial policy completely overrode traditional monetary policy.
Right from the White House, President Trump announced a historic domestic chip-making alliance.
And the players here are the absolute apex of consumer technology.
Intel is formally pivoting to become the primary domestic foundry to manufacture Apple's highly complex custom-designed processors right here in the U.S.
The sheer scale of this pivot reshapes the entire global semiconductor supply chain.
It's massive. Intel's stock surged 10% immediately, hitting 133.82.
Just exploded on the news.
And the mechanics are wild. This Apple and Intel deal, it's like Ford suddenly deciding to halt their own sedans to custom-build proprietary engines for Ferrari.
That's a great way to put it.
And the U.S. government is effectively co-signing the loan to make sure the assembly lines actually get built.
Because Apple is the most demanding consumer of advanced silicon on the planet, Intel securing their validation legitimizes Intel's entire turnaround strategy.
But the deeper layer is the government's financial entanglement.
Oh, absolutely.
Now, we really have to remind you listening that we are remaining entirely impartial about the politics here. We're looking at this strictly from a market perspective as presented in our sources. We're not endorsing any views.
Purely market mechanics.
Right. So from an economic perspective, how does the government's equity involvement change the landscape? The sources say the U.S. government holds a 10% equity stake in Intel.
They do.
And as a direct result of this Apple deal, that stake skyrocketed from $10 billion to over $60 billion. How does the government come to own $60 billion of a public tech company?
Well, the mechanism dates back to the SHE-KES and Science Act grants. Those massive federal subsidies for domestic manufacturing were often tied to warrants or equity provisions.
Ah, to ensure taxpayers get the upside.
Exactly. What we're seeing now is the realization of those provisions. The government isn't just a regulator. They are a heavily invested equity partner in American computing.
Blurring the line between free market enterprise and state-sponsored infrastructure.
Which is why the analysis piece dubs it the Silicon Shield. For decades, Apple, NVIDIA, AMD, they relied almost exclusively on TSMC in Taiwan for fabrication.
Which is a massive geographic bottleneck.
The ultimate single point of failure. By brokering this Intel-Apple deal and holding a $60 billion stake, the U.S. government is explicitly engineering a supply chain diversification away from Taiwan.
Anchoring it inside the U.S. to insulate against geopolitical shocks. It's national security disguised as corporate synergy.
Perfectly said.
And this domestic build-out wasn't just Intel and Apple. We saw massive moves across the AI ecosystem that same day.
The AI sector is transitioning from software to heavy physical industrialization.
Let's talk about Rumble. Most people know it as a consumer media platform, but they just finalized acquiring Northern Data AG.
Right. Restructured into Rum Group, Inc.
And launched a brand new enterprise unit called Quake AI.
And the hardware scale is what caught the market's attention here.
They integrated 22,000 NVIDIA GPUs. 22,000. Physically racked and powered, combined with Rumble's cloud network.
It positions them as a legitimate challenger to legacy hyperscalers like AWS or Microsoft Azure.
And the stock jumped 18% pre-market. They're targeting agentic AI specifically.
That's the critical differentiator. Generative AI is like you type a prompt, it writes a poem. Agentic AI is an autonomous agent.
So it does things on its own.
Exactly. You give it a high-level goal, and it breaks it down, navigates software, executes workflows, and course corrects without human help.
Which requires exponentially more compute power.
Precisely why 22,000 GPUs is such a massive competitive moat. Software is strictly bound by the physical limits of energy-devouring data centers.
And that leads directly to the utility sector news. Because you can't run those GPUs without an unbelievable amount of electricity.
Right, which brings us to the historic utility mega merger.
NextEra Energy and Dominion Energy announced a $66.8 billion merger.
A staggering amount of money.
And the sources note the driver isn't just standard consolidation, it's explicitly to pool capital to build out the power grid for these AI data centers.
You're seeing the vertical integration of the AI economy in a single day.
Yeah.
Intel securing the silicon, Rumble securing the servers, and NextEra and Dominion securing the high-voltage transmission lines to power it.
They're all symptoms of the physical domestic build-out of the AI era. And it's so powerful, it completely overrides the Fed. Tech isn't worried about Warsh's 4.22% rates.
Because the return on investment for securing the AI supply chain is exponentially higher than the cost of that debt. Tech and energy are in their own insulated reality.
Which begs the question, how is the actual everyday U.S. economy handling these high interest rates?
That is the big divergence.
Yeah, because we know tech is booming, energy is recalibrating. But for the average consumer, the data from June 18th is incredibly disjointed. The economy violently split in two.
The tale of two economies, entirely driven by how different sectors interact with the cost of capital.
Let's look at the consumer first. May retail sales dropped, and they rose 0.9%.
Crushing the estimate of 0.4%.
Right. Year-over-year sales are up 6.9%. So despite persistent inflation and the Fed holding rates high, everyday consumers are still out there swiping credit cards.
The consumer engine is running hot. But look at heavy industries that rely on financing.
Oh, the housing market is an absolute bloodbath. Housing starts plunged 15.4% in May to an annualized rate of 1.18 million units.
A definitive 6-year low.
We haven't seen numbers this dismal since the 2020 lockdowns. And multifamily starts, like apartment complexes, down an astonishing 40.2%.
A structural freeze of new inventory.
The NAHB and Wells Fargo index tracking builder confidence dropped to 35.
Under 50 is negative, so 35 is just terrible.
And 35% of builders are actively slashing prices by an average of 6% just to get foot traffic. 62% are using heavy sales incentives.
Yeah, desperation.
So what does this all mean? How is it mathematically possible that retail spending is booming while housing construction is falling off an absolute cliff? Are Americans just buying TVs because they can't afford houses?
This raises an important question about the affordability cliff. The blunt instrument of Fed rates doesn't impact all sectors equally or at the same speed.
Okay, walk us through that 40.2% drop in multifamily construction.
Building a 300-unit apartment is a multi-year, capital-intensive project. Developers borrow tens of millions from commercial banks before an excavator even shows up.
And those are floating rate loans, right?
Exactly. Tied to the exact short-term rates Warsh just spiked. When the cost of capital doubles from 3% to 6%, the profit margin vanishes. They just abandon the project.
The industry is being mathematically destroyed by borrowing costs.
But the retail sector operates on a totally different timeline. A 4.22% treasury yield doesn't instantly stop a family from buying groceries or a TV.
Even if credit card rates creep up to 22%, people don't always notice the minimum payment change right away.
Right. As long as people have jobs, consumer momentum continues.
And there's this perverse dynamic with housing wealth. The Fed's hikes created two classes of citizens. They are essentially subsidizing existing homeowners who locked in fixed 3% mortgages years ago.
Those people are completely immune to Warsh's pivot.
They have massive disposable income because their housing cost is artificially low, so they keep spending wildly at retail.
While the Fed treats new home buyers, and the developers trying to build for them, as collateral damage to cool the broader economy.
It traps the Fed in a vicious cycle. The Fed needs the consumer to stop spending to kill inflation. But because retail is so resilient, they have to keep rates punishingly high.
Which drops a nuclear bomb on the commercial development of new housing supply.
It's the ultimate irony. Paralyzing new housing supply guarantees that existing home prices and rent stay incredibly high.
And high housing costs are major components of the inflation indices. So by keeping rates high to fight inflation, they constrain the supply needed to lower it.
Smashing the wrong nail with a blunt tool. The domestic fracture is staggering. We have a state-backed tech boom, a frozen housing market, and an unstoppable consumer.
Ripping the U.S. in three directions.
So how is the rest of the world navigating this exact same day? These shockwaves don't stop at the U.S. border.
The global divergence on June 18th is a crystal clear map of where regions are placing their bets for the next decade.
Let's start with Asia, because the numbers were explosive. Japan's Nikkei 225 hit a staggering all-time record of 71,053.
Unbelievable numbers.
South Korea's KOSPI crossed 9,000, closing up 2.25%. And the sources highlight this is driven by massive semiconductor conglomerates like SK Hynix and Samsung.
North Asia is operating as the indispensable factory floor for the AI revolution.
Right. While the U.S. focuses on data centers and design, companies like SK Hynix are making the high-bandwidth memory chips.
The HBM chips, yeah. An advanced NVIDIA processor literally cannot function without them.
So they're secondary beneficiaries of the U.S. Silicon Shield momentum, insulated from U.S. interest rates by global hardware demand.
Which is why the KOSPI basically tripled in a year.
But then you pan over to Europe, and the atmosphere is entirely different, much more cautious.
Very defensive.
The Bank of England met the same day as the Fed, held their rate at 3.75%, but the vote was a highly divided 7-2, with two members demanding an immediate hike to 4.00% to fight inflation.
That division perfectly illustrates Europe's macroeconomic trap.
And looking at corporate earnings, you see the exact same divergence. Accenture easily beat estimates with a $3.80 EPS due to enterprise AI demand.
A huge corporate demand.
Jabil surged 14% on electronics manufacturing, but Kroger, the U.S. grocery chain, missed estimates with an EPS of 1.58.
Which shows retail resilience isn't evenly distributed. Lower-income consumers are pivoting to generic brands.
But my primary question is macro. Why is South Korea's market tripling, while the UK's FTSE 100 actually closed down 1% on a day when global energy prices plummeted?
It comes down to the fundamental composition of their economies. Europe is suffering a multi-year macroeconomic hangover. They don't have a hyper-growth tech sector.
Right. They rely on traditional manufacturing and legacy financials,
Which are brutally exposed to high interest rates.
Mm.
And Europe bore the brunt of the global energy crisis recently.
because they don't have massive domestic energy production like the U.S. does.
Exactly. They absorbed the shock of imported energy inflation, which permeated their service sector and wages. So the Bank of England is trapped.
Dealing with stagnant growth but persistent inflation.
Stagflation risk. That's why the FTSE closed down while the KOSPI surged. Capital allocators see Europe as restrictive and North Asia as the physical engine of the future.
The scale of what we are looking at truly is a great convergence. Let's summarize this incredibly dense narrative from June 18, 2026.
That's a lot to take in.
In 24 hours, the U.S. and Iran sign a 14-point peace deal, reopening the Strait of Hormuz, bringing down spot oil.
Colliding with the logistical reality of empty reserves and 20 million barrel tank bottoms in Cushing.
Then Kevin Warsh takes the Fed, discards forward guidance, triggers a bear flattening of the yield curve as the bond market prices in inflation fighting.
Sending gold tumbling as investors chase 4.22% Treasury yields.
But the tech sector ignores it because the White House announces a $60 billion Silicon Shield partnership between Intel and Apple to onshore AI.
While Rumble launches Quake AI with 22,000 GPUs and utilities merge to power it all.
All while the U.S. economy fractures. Retail consumers with 3% mortgages spend relentlessly, while the multifamily housing market suffers its worst freeze since the pandemic, crushed by the Fed's affordability cliff.
A breathtaking amount of systemic change for one day of trading.
It really forces a profound recalibration of how we understand the market.
It does. I mean, today we saw the U.S. government sitting on a $60 billion equity stake in a semiconductor foundry while brokering deals with Apple.
Yeah.
So, as you watch the markets open tomorrow, ask yourself, are we witnessing the final days of the traditional free market tech sector and the definitive birth of a new state-sponsored era of American capitalism?
Man, that is a massive structural question for you to chew on. It challenges everything we were taught about how these markets are supposed to operate.
The map has permanently been redrawn.
It really has. Thank you so much for joining us as we took this deep dive into the source material today. Keep digging into the data, stay curious about the mechanics behind the headlines, and keep your eye on that shifting landscape. Because if the great convergence of June 18th taught us anything, it's that the rules of the game can change in a single day.